SVB CEO Greg Becker joins us now on set in San Francisco. Good morning. Thank you for coming into the studio.
Yeah,
we were talking how we were sick of the Zooms.
I know. In person, yeah.
Exactly. So what's different this time around? If anything, the macro backdrop seems worse, and you kind of foreshadowed what we heard from the team at Microsoft last night. You think things are actually, you've seen a deceleration, an uptick in cash burn from your customers over the last few months. How does that bode for the upcoming quarters?
Yeah, I mean, I think about 23 as a transitional year. I mean, I'm happy 22 is over. I mean, the second half of 22 was very, very tough because it was really hard to predict exactly what was going to be happening. And as we saw towards the end of 22, we kind of felt that bottoming out. We've kind of felt that we were kind of at that lower point, and lower point does not mean, very important, that we're going to automatically see a big rise or a big improvement, right? What we are expecting to see in 23, first half, actually even venture capital, actually a little bit more of a decline, even than what we saw in the fourth quarter. But the second half was going to kind of create that modest improvement and really set the stage for a better 24. So we're optimistic because our crystal ball is a little clearer than it was in the third quarter last year.
How is it clearer? Do you think that you have a better idea of what the Fed is going to or not going to do? And I know that you've seen an uptick in debt financing, right, versus equity financing. What happens to a lot of your customers, startups, if interest rates move higher or stay at high levels?
Yeah, maybe to talk about like why that crystal ball is a little clearer than it was, right? I think about it in three ways. For that clarity, you need kind of three things, right? So the first thing is you need public markets, right, to kind of stabilize. So while we're not there yet, we certainly think in the first half there's going to still be more volatility. We're getting closer to that. When you look at multiples, right, when you look at software multiples and so forth, they're kind of getting actually a slightly below where the historical average was. That's a good thing. Second thing, when you think about interest rates, we don't need interest rates to decline. We just need them actually to kind of slow down or pause. And we think we're getting close to that. And the third thing is you need expectations, right, to match up with performance. And so we haven't seen that yet. That's the one that's a little more cloudy. But the first two, we think, in the first half, maybe this summer, are going to come into balance. And when that happens, that's the stability that we expect is going to kind of create that floor.
Now, you do have an incredible view into this. Approximately half of all VC investment dollars throughout the economy eventually flow back into deposits at SVB. What makes you confident on that valuation piece? We have this debate a lot on Tech Check and throughout the network. What is the right level? Do we go back to post-pandemic levels or further back when we were in a time of higher interest rates? A lot of the companies and your customers of the last decade have been raised on growth, and not exactly profitability and free money.
Well, profitability is the name of the game. People are talking about it pretty much, consistently every interaction we have. But you think about it, what drives valuations, right? So it's the growth rate of the business, right? It's the margins that you have, the sustainability of the business model themselves. And all three of those are actually in better shape than you've seen in other cycles. So we think it's going to go back to pre-pandemic. So whether it's 17, 18, maybe 19, but certainly not 20 and 21. I don't see that coming back for a long time, maybe ever, but it doesn't need to. It doesn't need to create a really kind of a stable environment.